Good afternoon, everyone. This is your editor-in-chief, John Darcy, here for the daily recap. We continue to have choppy action in the market as this Cyprus news remains in the headlines. We didn't get any resolution to all of that today as that bailout remains in flux. So in these headline-driven tapes, traders generally like to advise paring down risk a little bit, taking a step back, sitting on your hands, and waiting for the technicals and the charts to really start driving the action again. If we go straight away to the spider chart here, we can see the volatility we got intraday today as we got some more news about what's going on over in Cyprus. It's a tiny little European country, but it's having this huge effect, in the short term on world markets, and it goes to reinforce the fact that this European debt crisis is a very hot topic still and a source of anxiety for the markets. We were able to close well off the lows, and it didn't turn out to be anything really significant from a technical standpoint, but I would continue to monitor what's going on with that Cyprus situation, with the headlines, especially in the sectors that are most sensitive to the headlines like the banks and things like that. We'll start off with Apple here, going on a stock-specific basis. And today Apple was a little bit unimpressive, which isn't surprising given some of the weakness that we've seen in Apple over the last several months. We had a strong three-day run-up in the stock, and it came up into resistance of the 50-day moving average, which after that, it finally broke out of that downtrend and is trying to work its way higher. It's not surprising to see it run into a little bit of resistance, but overall, I would still say Apple is looking a lot better than it has recently, and I know Scott and Mark and guys like that on the virtual trading floor are going to stick with this and see if it leads to something a little bit bigger. But definitely watch that 8 and 21-day moving average as they start to curl up. And let's see if those start to act as a little bit of support for Apple on any sort of retracement. LinkedIn, Netflix, and Google are three stocks in the tech sector we've been talking about that have been leaders over the course of the last few months during this move to all-time highs in the Dow and the S&P. But those are three stocks, among others, that we've seen weaken in that sector that are a little bit a sign for caution from a trading perspective right now. We'll go ahead and take a look at the chart of Netflix first, because I think Netflix is teetering a little bit on the edge of some important upper level support. It held just above its 21-day moving average today, or maybe just below, but it's right near that level, and that's going to be a huge level to watch, in addition to this upper level floor, that the low on this candle is 176.16. So if we get some more weakness in Netflix, I would definitely watch that as your pivot, as a potential area that you could see Netflix retrace deeper support levels after this huge move after earnings. It was at $100, and then in about a month it was up at $180. And you got about an 80% move there. It almost even got back up to the $200 level. So it's not surprising to see some backfilling and some corrective type action after a huge move in Netflix. But it is a sign for caution as this risk-off trade is starting to show its face a little bit. LinkedIn is the other one that lost its 8-day moving average yesterday and wasn't able to bounce as strong as the market did. And then today you saw LinkedIn unable to reclaim that 8-day moving average. And it looks destined to really retest this 21-day area. You have this small cluster of support here, and then you have this sort of prior breakout level that could be another area that you could see LinkedIn retest. It wouldn't be game over for the stock, but you're starting to see momentum sort of peter out of this market as we get near upper levels. And Google today actually held up better than those two, but it continues to be a little bit lackluster. You do have a nice little descending channel to sort of trade off of, which is something that traders really like to see in order to measure risk on a trade and potentially time entries. So if we do get a definitive break back above this 8-day moving average and out of this descending channel, I think you could see some upside momentum come back into Google, but traders should definitely be patient and wait for that move out of that descending channel to happen. I think the banking sector is one you really have to watch right now as the Cyprus news is in the headlines. The banks are especially sensitive to anything regarding the European debt crisis, especially when it revolves around the banking system in Europe with Cyprus, with these potential deposit levies and this unique type of bailout that they're pursuing in Cyprus. So you've seen relative weakness and strength within the sector based on how much these banks are exposed to Europe and stuff like that. And if you look at a stock like Goldman Sachs, it has been weak in addition to Morgan Stanley among the U.S. banks because of its exposure to Europe. And its overall sensitivity to the European debt crisis. We'll go to the charts here. Here's a look at the XLF. You can take a look at Goldman, obviously a little bit weaker. It's here at this floor, which is going to be an important level technically for Goldman Sachs as it comes into its 50-day moving average as well. And if it loses this support and support of the 50-day moving average, I think you could see some weakness come into the market as a result, as the banks have been one of the sectors that's been leading the market higher. You take a look at Morgan Stanley. It has also been weak, very similar looking chart to Goldman Sachs based on this Cyprus news and this European focused tape. And then you also take a look at a couple of European banks, Deutsche Bank, obviously a high-profile German bank, even more weakness, obviously because it's in Europe. It's directly tied to all the stuff that we're reading about the European banking system, breaking below its 200-day moving average, which is a huge complexion change. Looks like this open gap potentially could be an area. If we continue to get a lack of resolution to this situation in Europe, that could be an area that we test. We'll also take a look at Barclays, another European bank that has been weak on this news. It looks a little bit more like Goldman Sachs and Morgan Stanley, where it's holding this pivot support area. But if we do break below that, the 200-day moving average could come into play. I mean, that's a little bit more of a longer-term time horizon, but you're seeing that with Deutsche Bank, a lot of weakness. So keep an eye on Morgan Stanley, Goldman Sachs, and Barclays in the banking sector. We'll also take a look at Bank of America, as that's been the one Scott has been playing long recently among the banks, and it's been a terrific call by him as Bank of America passed the Fed's capital plan review with flying colors. The company it's a $5 billion share buyback, I believe, that they're going to initiate with their new capital plan, and they're also going to redeem $5.5 billion in preferred shares. So great things happening with Bank of America. You know, it's one of the laggards during the financial crisis, and it's come a long, long way. But I think this is one that you can continue to play if you want to be exposed to the banking sector. It looks like this might be the one, especially with all these European winds swirling. A couple other things to look at today. We are seeing sort of at the tail end of a rally, you start to see some laggard type names perk up. You know, as money gets exhausted flowing into leaders, you see stocks, you know, that are laggards, that do have high net float shorts, highly shorted stocks, can potentially wake up, and you can see money rotate into, you know, groups that maybe have some more upside as investors deem that the leaders are a little bit cooked, a little bit extended. And an example of that, one that doesn't necessarily have an action area set up right now, but is an example of one of those laggard stocks that's been acting really well, is Green Mountain Coffee. The company came under a lot of scrutiny for its accounting practices and all types of stuff. And you see, if you zoom out, it was trading at 120, traded all the way down to $20 a share. I mean, it got absolutely crushed. But if you take a little bit of a contrarian point of view, once you get it at these really, really diminished levels, you can get a great trade. And you know, the stock's traded from below $20 and is now up at 56.19 is where it closed today. And then over the last few weeks, like we talked about, money flowing into these laggard names. It's held its 50-day moving average, and now it's above its 8 and 21 also, acting really well after a gap up and hold today. Ones that do have perhaps some actionable setups and are holding up well among that laggard group that I was talking about, BBRY, Research in Motion, you know, changed its symbol a little while back, and it's been a lot better since changing that symbol. It's maybe proving that a rose by any other name actually does smell sweeter, so I guess Shakespeare didn't know what he was talking about. But BBRY is holding up well. It's got a really nice wedge pattern here. If we get our line tool out, we can draw that nice wedge. You know, higher lows and lower highs that's how you define a wedge pattern. And it's getting tight here. You sort of have a mini wedge, which is something Scott likes to draw as well. So you know, we're coming near a little bit of an apex in BBRY. I know this is something that Mark Sperling has been playing a lot and likes it long. To be something definitely to keep an eye on. Still got our line tool there. Another one is FSLR, obviously the most high-profile solar stock. Let's get this line tool out of here. It is also, you know, it gapped down on earnings, but sort of held around its 200-day moving average. You know, you like to see when a stock does break its 200-day, does it accelerate below it, or does it try to get back above it and hold over the next several sessions? And you saw FSLR actually be able to climb back above, you know, find support here at its 200-day, and it's actually breaking above this little pivot and into this gap. Maybe if you're looking for a laggard type play, FSLR is a highly shorted stock that could get some upside in this area, I think. A couple other names. Last week, I can't remember whether it was the morning call or the daily recap last Friday, was talking about Best Buy and about how that's a laggard stock. Oh, not JBBY, BBY. Not BBY7. BBY, how that is another laggard name that's had a huge move. It's had a 100% move from the lows around $11. It's just another example and a reminder of what you can get if you take a contrarian view on a stock that is really beaten down, that or people are really hating. And I talked about how JCPenney sounds like a similar story to me. You talk about these brick and mortar stores, these traditional retail outlets that are really struggling in today's world of online shopping and whatever you want to say about the fashion industry. But JCPenney is one that people have become really bearish on, but it looks like slowly but surely Ron Johnson might be tweaking the business model enough that JCPenney at this price could be somewhat attractive, at least for a trade. And we saw a big move in JCPenney. After I made that call on Friday, Monday, we saw that big move. It was up as much as 10, 11% during the session. I think it ended up closing up about 6 or 7%. Today, it wasn't able to add on to those gains, but I think you continue to see upside in JCPenney, perhaps up into that gap, similar to what you saw with FSLR. We're going to look at a couple other names that have been a little bit weak recently as perhaps signs that there's weakness under the hood, which was the title of Scott's afternoon note today. That even though the markets are holding up near highs, there are some signs of weakness. The credit cards, which have been a leading sector in this market for a while now, are starting to weaken a little bit as well. Visa in particular, this line tool is killing me. So Visa has got this important upper level support here around 154.30 is the low of this candle right here that I'm on. So that'll be an important level of upper level support to watch if you're trading Visa and looking for a potential follow-on weakness or follow-on strength on a stock that's been basing near upper levels. But it's just like the banks, just like some of these tech stocks. If we do start to get additional weakness and we break below these upper level pivots, it could lead to more downside in the broader market. The one last thing we'll take a look at, another sign of potential weakness. I hate to be such a bearer of bad news and rain on the parade of the market here, but we talked last week about how potentially money could be rotating into the oil service group as money rotates out of some tech leaders. And scratch that, because this week we've seen extreme weakness from the OIH and stocks within that ETF. You look yesterday, it was even more apparent in SLB, which looked like it was breaking nicely out of a little wedge pattern here. It was above all of its moving averages. The 50-day was curling up, but you saw a big gap down yesterday. And then you look at the gap and you say, all right, can it fill some of the gap? Can it repair a little bit? No, yesterday it gapped down, continued down, and that gave way to today's even more extreme weakness that took Schlumberger, it's a tongue twister there, all the way down to around its 200-day moving average. It did hold the 200-day today, but this is definitely something to take note of in SLB. You look at the OIH, it's not quite as extreme, but you see, a pivot support level here. They got tested and held today, but I think you could potentially see OIH and its component stocks weaken a little bit. So that'll about do it for today's daily recap. The theme perhaps was that you're seeing some weakness under the hood, like I talked about, some signs that the market's getting a little bit long in the tooth after this rally to all-time highs in the Dow and near all-time highs in the S&P. And then you have this European news as sort of, Cyprus is a small country. I understand contagion and all that type of stuff in the banking system, but I think this is an excuse for some profit taking also in U.S. markets. And it's also a sign that even several years removed from the financial crisis, that investors are still jittery, and you can have that stairs up, elevator down type of situation in the markets that has a lot of investors still scared to jump back in. But it should be an interesting rest of the week in the markets as we have the action loosening up a little bit. I know traders, even though it's not the easiest action to read, are a little bit excited about the fact there's a little more volatility and tradable moves in the market right now in both directions. But this is John Darcy here for your daily recap, and we'll see you on the morning call tomorrow and in the virtual trading floor.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, We teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.